So if you're an investor looking ahead to 2026, you are facing a massive dilemma. On one side, you have this incredible story, promising a technological revolution, a great acceleration that's going to reshape our economy. But on the other side, you have the hard data, which points to some serious headwinds and a much more, sobering reality. Our job today is to navigate this gap between the hype and the numbers.
And this is the vision, right? This is what's really captured the market's imagination. ARK Invest calls it the Great Acceleration. We're talking about this convergence of world-changing technologies, AI, robotics, blockchain, you name it. They're all promising to kick off this unprecedented era of economic growth. It's a really powerful story of the future arriving at lightning speed.
I mean, it's a super compelling vision. But, as analysts, we have to ask the tough questions. What are the risks that might be hiding behind all this hype? What happens if this bright, shiny future doesn't show up exactly as planned?
And to answer that, we really need to dissect the two very powerful and very different stories that are shaping the investment world for 2026.
So on one hand, you've got this wildly exuberant, forward-looking narrative, this belief that AI-driven tech is creating a massive economic boom. And then on the other hand, you have the sober, institutional view, which is grounded in economic models and warns of some pretty big headwinds that could keep that growth in check.
Okay, so let's dive into Act 1, the case for all this technological optimism, the great tech acceleration. This is the story of explosive, game-changing transformation.
At the heart of this whole optimistic case is AI. ARK's research sees it not just as some standalone technology, but as the central dynamo for at least 5 other huge innovation platforms. They see it as the catalyst for everything from robotics to energy storage, basically creating a force multiplier for economic transformation.
And this right here gets to the core engine of the whole idea, convergence. See, these technologies aren't in their own little silos. Advances in neural networks make intelligent devices smarter, and both of them depend on the next-gen cloud. This interplay creates this amazing, virtuous cycle of accelerating innovation, which is the foundation of this whole very compelling story.
All right, deep breath. Now let's pivot to Act 2. We're going to step away from that exciting vision of the future and look at the cold, hard data that's defining the present. This is the cautious economic reality check from an institutional perspective.
Okay, let's ground ourselves in the data. This table from Vanguard paints a much more constrained picture. If you look at their main 2026 forecast for the US, you see projections for just moderate growth, inflation that's sticking around, and low unemployment. It's a picture that clashes pretty sharply with that great acceleration story.
And this is the key number right here, 2.25%. That is Vanguard's forecast for US GDP growth in 2026. I mean, it's solid, sure, but it is not the explosive, transformative growth that the tech narrative is promising. So what explains this huge disconnect?
Well, Vanguard's analysis does acknowledge that AI investment is a real positive force. But, and it's a big but, they argue it's being offset by major headwinds, what they call stagflationary shocks. These are things like new tariffs or slowing population growth that kind of slow growth and push inflation higher at the same time. It's a classic case of one step forward, one step back for the economy.
And this brings us to the absolute crux of the entire debate, the single biggest risk factor that institutional analysts have identified, the AI investment cycle itself. Vanguard actually quantifies this risk with a specific number. Their modeling shows a 30% chance of a downside scenario. Think about that. That's a nearly 1 in 3 probability that this massive wave of AI investment either stalls out or just plain fails to deliver on its huge promises. For any portfolio, that is a significant risk you have to manage. And here is how Vanguard describes that 30% scenario in their own words. It's a future where, quote, AI disappoints and exuberance is irrational rather than justified. That is a blunt and pretty powerful warning against getting swept up in the hype.
So what would this 30% downside scenario actually mean for your portfolio? The consequences would be severe. Really weak growth, a sharp drop in stock market valuations, and as you can see here, a potential lost decade for stocks, with 10-year average returns hovering somewhere between -2 and +2%. Ouch.
So, we have the hype and we have this very real risk. How in the world do you build a portfolio for that kind of environment? Let's take a look at the institutional playbook for navigating 2026.
The strategy that Vanguard proposes is built on 2 core pillars. First, a preference for high-quality bonds. And second, a strategic shift within your stock allocation, moving away from growth and toward value stocks.
So let's explore that first point. Why bonds? Well, as the quote says, after years of basically zero interest rates, high-quality bonds now offer compelling real returns. What that really means is their yields are high enough to beat the expected rate of inflation, which is a total game changer for building a stable portfolio.
But the role of bonds here goes beyond just simple yield. Critically, high-quality U.S. fixed income is positioned as the primary financial shock absorber. It serves as the key portfolio diversifier if that 30% AI downside scenario actually happens, providing a much-needed buffer against a sharp drop in the stock market.
Now for the second piece of the strategy, that shift in equities. This slide really clarifies the choice. The growth thesis is basically a bet on the AI innovators themselves, the companies building the technology. The value thesis, on the other hand, is a bet on the broad economy, all the companies that are going to adopt and use that technology to become more efficient.
From an institutional perspective, the more prudent bet right now might just be on the adopters. And the reasoning is pretty clear. The AI creators have these extreme valuations that have already priced in years and years of success. In contrast, value sectors like industrials and financials haven't yet fully baked in the long-term productivity gains from AI, which is why they might offer more attractive returns looking forward.
And this brings us to the core takeaway. This institutional playbook isn't about predicting the future, and it's not a bet against AI. As the quote says, this strategy is designed to be prudent no matter whether today's AI exuberance ultimately proves rational or not. So the critical question for every investor heading into 2026 isn't just which story is right. It's, is my portfolio structured to withstand being wrong?